Hey everyone, thanks for checking out this video. My name is Travis Rose. I'm the creator of the Master the Market education that you can find linked below in the description. And this is going to be the second part of the Day Trading Stocks for Beginners series that I'm doing here on my channel. So if you missed the first part and you're brand new to trading, you may want to start off with that video first. And I will of course have that linked down below in the description. Okay, so the goal of this series is to start from the basics of day trading stocks and gradually each video get a little bit more complex until you're able to actually understand what day trading is and how you can profitably do it with simple and effective trading strategies. Okay, so in the last section we talked about day trading and the pros and cons of day trading, how to set up your brokerage account, and we went over a few different options when it comes to actually opening a brokerage account in the first place. And here in this video I want to start talking a little bit about trading itself. So like I briefly mentioned in the previous video, there are actually two ways that you can profit from the market. Most people always think of the fact that you can profit from stocks going up, but realistically, you can actually profit from stocks going down as well. So first and foremost, when you're buying or quote-unquote longing or even going long, that simply means that you're buying into a stock to open a position and then later on selling that position to close it, ideally at a higher price. So when you're buying stocks, the goal is to, of course, buy the stock low, sell it high, and then profit the difference between where you bought and where you sold multiplied by the number of shares that you traded. So for example, if we take the diagram here at the bottom, you can see that the green dot on the chart is where we would buy into the stock, and the red dot is where we would sell our shares. So if we were buying 1,000 shares at $1 per share, and then selling those 1,000 shares later on at $1.10 per share, our profit in this case is going to be 1,000 shares multiplied by the 10 cents in profit that we made, giving us a $100 profit. And like I mentioned, this is really how most people think of profiting in the stock market, whether you're day trading, swing trading, or even longer term investing. You ideally want the stock to go up so you can buy low and sell high. However, one thing most people don't realize that for me was actually kind of a game changer in my trading, because at the time when I first got started, it seemed like every time I bought into a stock, it was pretty much all the way up at the top, and it seemed to fall down immediately after I bought into it. So when I found out about short selling or quote unquote shorting or going short, it really opened my mind up to a whole new way of trading that actually allows you to profit from stocks that are going down. So when you short sell or when you short, all you're doing is opening a position first by selling and then later on buying to close, or in other words, buying to cover your position. And the way that this works is you're borrowing shares from your broker when you think that the stock is going to go down, and then you're selling those borrowed shares at a high price. Later on, ideally, the stock falls down. You buy back the shares, they automatically are going to get returned to your broker, and you will again profit or lose the difference between where you bought and where you sold, multiplied again by the number of shares traded. Okay, so just like when you're buying, you still want to buy low and sell high. The difference with short selling is that you're going to be selling those shares first, and then later on you're going to be buying those shares back, hopefully at a lower price. So just like the example before when we were buying the stock, in this diagram we have the red dot representing where we would short sell the stock, and then later on the green dot is going to be where we would buy to cover, or in other words, buy to exit our position on our short position. And for this example, let's say we were shorting 500 shares at $3 per share, and later on we were covering those 500 shares at $2.80 per share. So because we profit from stocks going down when we're short selling, in this case we made 20 cents per share with 500 shares, so 500 times 20 cents again is going to give us a $100 profit. Now with that being said, I do recommend that if you are brand new to trading, you stick with simple buying and selling before you get into short selling and covering, because it's best to just stick to kind of the basics and stick to one thing before you move on and spread yourself too thin by trying to trade all of these different types of strategies. And also with that being said, short selling is a little bit more risky than buying and selling, because if you think about it, there's really no limit to how high a stock can go. And if you're short selling, that means that you're losing as the stock goes higher and higher. So if you're not careful and you're short selling stocks that have potential to go very, very high and run very, very far, in a way you're kind of playing with fire, and it's very important to be able to manage your risk while doing so to avoid yourself from taking a big loss. So now that you know the different types of trading, both long and short, one thing that you're going to have to specify before you place any order, whether it be to buy, sell, short sell, or to buy to cover, is the actual type of order that that's going to be. And the order type is actually going to have a significant impact on how your order is executed. And because of that, it's going to have a significant impact on the price of your position. And at the end of the day, there's really nothing more important than the price of your position, because if you're buying a stock and you have a great execution on that order, allowing you to get in at a very low price, it's going to be much easier for you to sell at a higher price and profit on that trade. Okay, so the first order type that I want to talk about is what is known as a market order. A market order is an order going to be executed immediately at current market prices. Now, personally, I rarely use market orders unless for whatever reason I'm in a very urgent situation and I want to enter or exit a position as quickly as possible. And the reason that I don't use market orders very frequently is because if you think about it, every time you buy a stock, there has to be somebody on the other side of that trade that is selling you the stock. So if we take the example down at the bottom, we have the stock symbol TSLA for Tesla stock. And if we were buying 100 shares at the market, that means we're simply buying 100 shares at whatever price we can get them at. So if the current price of Tesla was at $700 per share, but the closest seller was at $702, by using a market order, we would be buying our 100 shares all the way up at $702 because that's where the lowest seller is currently at. So you can see by using market orders, a lot of times you're not going to get the best fills on your positions. And for that reason, again, I really only recommend using them if you're ever in a very urgent situation and you want to quickly get in or out of a trade. The next type of order that you can use is what is known as a limit order. Now, I personally use limit orders on just about every single trade, both to enter and exit my trades. And this is an order type that is going to be used to buy at or below a specific price or to sell at or above a specific price. Now, because of that, limit orders are not guaranteed to be executed. In order for them to be filled, there needs to be buyers or sellers at the specified limit price. So again, if we take the Tesla example down at the bottom, in this case, instead of buying at the market, let's say we wanted to buy 100 shares at a limit price of $700. And let's say, for example, the stock is currently trading at $720 per share. Well, if we're setting our limit order at $700 per share, that order is simply going to sit there and wait for the price of Tesla stock to come all the way down to $700. And we're only going to get into that position if the price is at $700 or less. And these order types are really great for entering and exiting positions because one thing that you're going to learn in the future of this series here on my channel is that we can use very specific points on our charts, what are known as support and resistance, which again we're going to talk about in the future, for our entries and for our exits. And we can actually determine these prices beforehand, allowing us to set our limit orders to either buy or sell. And then later on, we simply wait for the price to hopefully reach our orders and fill them, giving us the best chance to profit on our trades. Or if they don't reach our limit price, we know that the trade was simply not worth taking, and we can go ahead then and cancel our order and move on and look for a better trade setup. Okay, and the last order that I want to talk about is what is known as a stop order. Stop order is going to be used to buy or sell immediately once the stock reaches a specified price. Stop orders are commonly called a stop loss, and really what they do is they allow you to automatically cut losses on your position when the stock reaches a specified price. And because of this, this is a great way for beginners to manage their risk because at the end of the day, one thing that many people learn the hard way is that cutting losses on your own is much easier said than done. And at the end of the day, cutting losses quickly is easily one of the, if not the single most important rule to trading stocks profitably. So in other words, I highly recommend using stop orders or stop losses when you're getting into trading to allow you to manage your risk without having to do so manually. And the way that stop orders work, if we take Tesla's stock, for example, at the bottom, in this case, we have an order to sell 100 shares with a stop on quote order selected, and we have our stop price set at $699. Now, what that means is if the stock gets all the way down to $699, this order is automatically going to turn to a sell order at the market and is going to immediately exit out of your 100 shares for you. And again, this can be very handy because, say, for example, you bought into the stock at $705, and you know that maybe there is a level of support at $700. So in other words, you're expecting the stock to stay above that $700 price. So with that being said, if the stock happens to break below $700, you know that you want to cut your losses quickly and exit out of your position. So you could set your stop loss order, in this case at $699. So that way, once that $700 price of support breaks, you would automatically be out of your position and it would automatically cut your losses for you. Okay, so I hope you enjoyed this video. If you did, please make sure to give it a like and subscribe to the channel so you don't miss out on part 3 of the series. Also, if you want to save yourself some time and you want to learn all of the strategies and techniques that I use to trade stocks full time, you can visit the first link down below in the description to visit my website, Master the Market. We have a total of 8 courses and over 15 hours of trading content for day trading, swing trading, and long-term investing. And we even have 70 practice quizzes and access to our trading chat room with over 1,000 active traders. Anyway, thanks again for watching the video. I hope you enjoyed, and I'll see you guys in part 3.